Good afternoon. Welcome to the Section 199A update. This is Alan Gassman. I'm here with my partners, Christopher Denicolo, Ken Crotty, and Brandon Ketron. And we have been working over the weekend to update our outline and this PowerPoint for what happened last week. And what happened last week was that there was an ABA-sponsored webinar led by Bob Keebler and Steve Gorin with two of the IRS attorneys who have drafted these proposed regulations for Section 199A. So we've listened to that presentation. We have looked at Steve Gorin's beautiful 400-plus page outline summarizing the proposed regulations and a lot of his thoughts in this area. And we've gone back to our own sources, and we have revitalized a little bit here, and we wanted to share what we learned and where we think we are now in this area. Now, let me point out the PowerPoint you have in front of you has a few typos. We apologize for those. But also, the only pages that we've really changed, besides the first pages you'll see, are pages 37, 41, 54, 60, 71, and 95. And we're not going to cover this outline in any great detail. We just want to tell you what we think we heard when this was discussed on the 13th. So I published a Forbes article or a Forbes blog on Saturday, which talks about this. The good news is that there really were not any surprises in the presentation. The bad news is that really nothing significant was clarified, and it does look like they are intent on taking away a lot of the benefits that you could have under Section 199A for trust planning and for separated entities, which we will discuss. Please keep in mind that a lot of this discussion has to do with proposed regulations. There's going to be a hearing in October, as we'll tell you about in a few pages. Everything is subject to change. I learned a long time ago not to pay too much close attention to proposed regulations and proposed laws, because you just get confused later when they actually pass. But on page 5 of the PowerPoint here, they did discuss that the definition of a trade or business would come under Code Section 162. So a triple net leased building in most situations is not going to be considered to be a trade or business, and the net income from that arrangement is not going to be deductible under Section 199 capital A. So you're going to want to advise your clients that their lease arrangements are going to take more management authority on the part of the lessor in order to qualify for the 199A deduction. It's interesting that Steve Gorin's outline indicates that the rules are going to be will be much more liberal when you lease equipment or furniture. And he cites a lot of case law where the courts have found that equipment leases are a trade or business, where a real estate lease, or at least a triple net real estate lease, is not a trade or business. If you read the proposed regulations, you probably recall the examples where someone is leasing a parking lot to an airport, and that regulation says that he is managing this parking lot as part of the arrangement. Brandon, do you want to talk about my number 2 here on page 5?
Yeah, so there was some discussion on whether a trust could receive a D&I deduction for income that it distributes to a beneficiary, which under normal circumstances would be taxed to that beneficiary at their rate brackets. So we were assuming that any income that a trust would receive for Section 199A, you would have a $157,500 threshold at the trust level. Any income distributed to the beneficiary would be calculated at their level and based on their threshold. The proposed regulations changed that. They said that the trust just gets one $157,500 threshold, and that's calculated without regard to any deduction for distributions to beneficiaries. And they talked about that a little bit on the webinar, and the IRS personnel that was there said that that is going to be the case, that they're not going to take into account distribution deductions. They're very concerned with the ability to manipulate that by distributing to different beneficiaries with low income tax brackets. So that is a little clarification there in regard to the distribution deduction.
And Steve Gorin gave the example of $300,000 of income going into a trust, which then distributes $150,000 to the beneficiary. And somehow, according to the proposed regulations, that trust and that beneficiary would only be entitled to one trust exemption, so to speak, of the 157.5. No one seems to have any earthly idea on how you divide that or how you allocate it. Steve Gorin in his outline discusses how you allocate depreciation deductions when a trust has property that's depreciable and makes distributions. So we'll just have to stay tuned for that. And we're going to talk a little bit more about this later. Please keep in mind that grantor trusts, trusts that are disregarded for income tax purposes and considered to be owned by the grantor or considered as owned by a beneficiary, do not come under this limitation rule. And they include qualified Subchapter S trusts, or QISs, which we'll talk about in just a few minutes here. Okay, number 3, they discussed a special type of trust that owns S corporation stock called the Electing Small Business Trust. And Ken, do you want to give us a brief introduction on this, and then we'll go into more detail in a few minutes?
Sure. An electing small business trust is one of the 3 types of trusts that can own S corporation stock. And what we'll clarify in a little bit more detail later is that there was a question regarding whether with the SBIT trust, because of the way you calculate the income tax for an SBIT trust, with a separate share for an S corporation assets and non-S corporation assets, the question was whether you had 2 thresholds. And according to the IRS, it's going to be clarified that you only have 1 threshold of the 157,500 for the trust, not 2, even though the calculation is done in 2 separate shares.
Right, and many people have been exchanging emails, almost certain that you would have 2 separate limitations, 157.5 for your S corp income and 157.5 for the other income of the trust, but they were clear that that is not what they intended. We also, under number 4, they talked about the concept of disrespecting an irrevocable trust that is set up for the purpose of avoiding tax under 199A, which Steve Gorin coined the phrase evil intended trust. So if you have an evil intended trust, the trust is to be disregarded, which means the tax savings from 199A would not apply. And Steve Gorin also went into example, or at least a question, what if you have the evil intent one year, but you don't have the evil intent the next year? So we do know when you use a complex trust with the 157,500 threshold, if you do that for the purpose of avoiding tax under 199A, it may not apply. We'll have to see what the final regulations say. And by the way, Judge Learned Hand's quotation comes from the early 1900s, not the early 1990s. This was before Abraham Lincoln invented the internet. Number 5. Chris, do you want to talk about 754?
Sure. So another little quirk of the 199A proposed regulations is that they almost disregard a 754 election for the purposes of determining the adjusted basis when you use the 2.5% qualified property calculation. So, typically speaking, under 754, if there's a sale of a partnership interest or if a partner dies, the partners can make an election to get a basis adjustment under 734 or 743 so that the inside basis of the partnership assets have a commensurate increase in basis based upon the fair market value of the partnership interest or the sale price of the partnership interest as applicable. Well, some planners thought before the regulations that if you do a 754 election and you get the inside basis increase, that just increases the basis of your assets for a partnership that you can use in calculating the 2.5% of qualified property test if you're determining eligibility for the 199A deduction. Proposed regulations torpedo that idea, and the folks from the IRS confirmed this by saying The IRS really didn't want to have a double counting of basis, but really the idea here was to prevent abuse on the sale of a partnership interest. I don't think the IRS has figured out how to handle this best because, obviously death is such an independently significant moment by itself that that's not going to be used to abuse the tax law. And I think what they said was they're going to get back to us. We should expect some more guidance on maybe how to accept death from this particular quirk in the 199A law.
Yeah, I have not had a client come to me and say that they were willing to die to get a new basis. That's,
no.
It'll only complicate their decision as to whether to die if it has to do with a partnership.
Certainly. Well, at least the plan around this, though, are to either liquidate the partnership so that the partners themselves have the assets that are appreciated, and if someone's going to die due to a short life expectancy, or if there's going to be a sale of an asset, you can get a better basis increase for this 199A deduction. Or if you somehow make the partnership disregarded, if it's a single member or almost a single member and you could just buy someone out to get this favorable tax treatment, might be better.
Right. If you want the creditor protection of a multiple member LLC or a limited partnership, but you want it disregarded for income tax purposes to get your step up, then the owners can simply be your client and then a grantor trust considered as owned by your client for income tax purposes. So that's where that's going to be. Item number 6, it was discussed, and you can also see it in my Forbes article called Beautiful Losers, the discriminatory nature of the 199A proposed regulations, that the fact that our law firm has a separate entity that owns our building and that we are a legitimate landlord for the law firm does not allow the write-off of 199A for our rent income in the same way that an engineering firm would get it, because the law firm activity is tainted by the building. And this is exactly what they intended to do, and they aren't at all regretful of it. So, and this is where now we'd have to put our building into another entity owned less than 50% by people related and affiliated to our law firm. And if I did that, if my best friend John Smith had a building and I had a building and we put both buildings into an LLC, I own 50%, he owns 50%, I don't own any of his law practice, he doesn't own any of my law practice, that may work unless the attribution rules have double attribution. So I think we'll just all have to stay posted in that area as well. Then there were some solid examples of movie directors and coaches, and they were clear that movie directors and coaches would be treated under 199A as entertainers and athletes. There was other discussion on the question of whether a law firm's activities in writing title insurance and doing real estate closings would be considered specified trade or business. And the IRS attorneys said that they did not want to get into any further discussion because it all is facts and circumstances related. So I would think that if our law firm had a separate title company that just did traditional title work and closings by a paralegal, not a lawyer, and did not render legal opinions or do work that a lawyer would do, that we might be able to have a 199A deduction there. Page 10, I've just given you a couple charts that you can use to explain the 199A deduction and the complex trust. Page 12, I've given you the street address that you can mail your comments to for these regulations, and you do have the public hearing October 16th at 10 a.m. at the IRS auditorium. We don't know whether there will be milk or cookies, so probably bring your own snack if you need to eat. So why don't we go now, Brandon, to page 37 and have you walk us through or lead us in the discussion on these specific pages from our outline that are now slightly updated to take this webinar into account.
Yeah, so these are basically just the winners and losers under the specified service trade or business definitions that came out under the proposed regulations. At least for the health industry, they did some clarification there. Pharmacies, physicians, veterinarians, physical therapists, they're all going to be considered specified service trade or business. There was an exception for health clubs or health spas that provide physical exercise or conditioning to their customers. That was specifically mentioned in the proposed regulations. There's some questions on whether just massage parlors will count as health or not health. So we're still waiting to see there. As far as the legal industry goes, licensed lawyers clear that they are specified service trader businesses. There was a carve out for delivery services, printers, or stenography services that's not included in the field of law. And then as we talked about earlier, there's a discussion on whether title insurance could be separated out or real estate closings, whether or not that's going to be considered law, and the IRS declined to comment further on that. So we're still kind of waiting to see there.
Brandon, can we talk a little bit about the 5% incidental
Yeah, so there
safe
was,
harbor and how that works?
the proposed regulations say that if you have a trader business that offers products basically separate or incidental to the specified service trader business, then if the sales from those products are less than 5%, it's not going to be considered a separate trader business and aggregated with the specified service trader business, and therefore you will not get a 199A deduction. If the sales are over the 5% threshold, then that can be considered a separate business. So one example I think is pretty common. If a dermatologist maybe sells sunscreen on the side as you walk out the door, if those sales from the sunscreens are less than 5% of her income, combined income from the sale of the sunscreen and her dermatology practice, then that's not going to be considered a separate trader business.
Okay, so if you go over 5% of your sales from a non-specified trader business in an entity that has a specified trader business, you can divide it out. But if you have less than 5%, then you lose the deduction. Right. So you might want to move that to a separate entity if you're allowed to under state law. How is that different than the de minimis exception that I'm showing on page 45 here?
Yeah, so the de minimis exception it basically applies if the entity has $25 million or less than annual receipts. If you have less than that in the specified service business, if you have a non-specified service business and then also partly a specified service business included as part of that, and your income from that specified service business is less than 10%, it's not going to taint the entire specified service or entire business as being a specified service. So an example that they had in the regulations is maybe a construction worker who provides consulting services as part of building a business or building a building. They're not going to consider that consulting work and taint the entire construction business as a specified service just because a small amount of specified services performed under that business.
Okay. And then what was the next page we wanted to cover?
49.
9, there we go. So this is what we discussed before, which is simply that you do need a real trader business. It can't be a triple net arrangement unless you are in the business of buying and selling and wheeling and dealing in triple net arrangements.
And the page before that, page 48, has some case law that kind of discussed rental cases and whether or not they've been deemed to be a trader business or not. So that's some guidance you can read into if you're curious there.
Great. Okay, let's go to page 54 now.
And that's, again, just related to the SBIT issue that we touched on before, that when you calculate the taxable income for an SBIT, you have to calculate the S corporation income and the non-S corporation income, and this assumes that you're not dealing with a grantor trust. But assuming you have a complex trust and you calculate the S corporation income separate from the non-S corporation income, you still only have the $157,500 threshold for determining the eligibility of the trust for the deduction.
And we'll all just wait and see what the final regulations really come out as. Okay, now we'll go to page 60. As we discussed before, your income threshold level for trusts and estates, and I mean trusts that are separately taxed trusts, is going to be only one threshold, 157.5 at the trust level. Page 71.
In 71, we're talking about qualified subchapter S trusts, which is another form of an S corporation shareholder as far as trusts go. So the difference between an ESBIT and a QUIST, which is what we have on page 71, is that with an ESBIT, you can have multiple beneficiaries. With a QUIST, the trust has to be structured so that there's only one current income beneficiary that receives the income from the S corporation. So the easier way to think about it is that a QUIST is very similar to a marital deduction trust in that you only have the one beneficiary that's entitled to receive the income. With a QUIST, because all the income flows out to the beneficiary, the IRS actually calculates the threshold at the beneficiary level rather than at the trust level. And so that's another distinction then between the ESBIT and the QUIST.
So with those limitations, I take you to page 73, Internal Revenue Code 678, which says that a person other than the grantor will be treated as the owner of a trust that the person has had the power to vest the corpus or income therefrom in himself. So I can set up an irrevocable trust for the benefit of my wife and my daughter. I can have my best friend be the trustee, not my wife, because of the grantor trust rules. I won't be a beneficiary. I won't have any right to replace trust assets or influence the trust. My daughter could be given the right to withdraw what I place into the trust on the day I form the trust, or the day at least that I've funded it. And then forevermore, this trust will be considered to be owned and taxed to my daughter for all purposes. So it's not a complex trust. Now, the trust gets income. If my daughter's income is less than $157,500 and the trust gets Section 199A income, then the deduction will apply, but I don't have to give the money to my daughter. If my daughter and I have a disagreement, I can go ahead and replace the trustee with Attila the Hun, and the Attila the Hun as trustee will continue reporting the income to my daughter, but not giving her any of it, while still taking the Section 199A deduction. So that's why we think these 678 trusts are going to be more and more popular. Now, you could form an irrevocable trust right now to start with and have it convertible to a 678 trust. There are private letter rulings that we found that support this proposition, where the trustee will give the beneficiary the right to withdraw, the beneficiary doesn't exercise it, and voila, you've converted a complex trust to a 678 trust. Right now, these regulations don't apply yet, so you could establish a management company to manage your law firm, and you could have that management company owned just by you, and you could take the 199A deduction until regulations are finalized. Once they're finalized, you could convey ownership in the management company to 678 trusts, maybe an irrevocable trust. So this planning will continue to be available, but it needs to stay flexible because things may certainly change. And we do have charts here that you can share with your clients. Let me go to page 95 now.
And this is just a confirmation of what we discussed earlier regarding the 754 election. So, as we discussed, the IRS is going to consider how to handle the step-up in basis on death as a result of a 754 election, but their intent is to prevent a double dipping of sorts with respect to basis if there is a sale of partnership interests with a 754 election in place.
Okay, very good. So we appreciate everyone who has attended today. I know we advertised this for 30 minutes, but we've gone over so many times. Finally, we're done early. If you will send us an email with any questions, comments, or suggestions, we will be more than glad to answer it. We'll be sending an updated version of this PowerPoint later today, which will have fewer typos, but still a few. And thank you very much for listening. May the rest of your day be productive and billable. Thank you.